Hey guys, as you know, I have started to put out these weekly market updates, weekly market outlooks every Tuesday. And last week I was traveling, so I couldn't do that. But for this week, let's try to make it quick and see what's going on in the markets. So let's start with my weekly market outlook, which I publish to our Discord members. Uh, First, look at the calendar. There is really not much going on this week. It's a short week, first of all, so only Friday markets are closed. On Thursday, we have GDP revision. Okay, it's not the first reading, it's a revision, but GDP revisions are um, can bring volatility to the market. So just be aware that markets can you will see it in the pre-market futures. Markets will go up or down based on if there is a GDP surprise in the second revision. But the main event of the week, which actually it's kind of weird that it's happening on Friday, but markets are closed because we are used to uh, seeing core PCE, CPI, PPI, all these things. Usually, these data points are released when markets are open. So, but this Friday, core PCE, which is Fed's preferred inflation gauge, is being released. And so we will see the market reaction on Monday. So just be aware of that. Now, looking at the indices. So if you remember from my last update, I had removed all my indicators from my chart and I had just put three moving averages: 8-day, 21-day, and 34-day moving average. And what I had mentioned was that if you are looking to go bear heavy on these markets, the thing is, the markets are, I mean, it's very obvious markets are in a bull run. So we are still going up, right? So there are, I don't think there are any signs of a pullback yet. There are some cracks appearing in some of the stocks, like the high flyer stocks, which I'll talk about in a second. But uh, if you look at the indices, the Dow Jones, Nasdaq, QQQ, IWM, like nothing is happening. You are just seeing a small pullback and it gets bought out and then markets keep going up. So that's what we are seeing. So going back to the moving averages that I'm showing you here. So what I've highlighted here is that in October, towards October end, when markets started entering this bullish phase, the 8-day EMA first crossed over, the blue line is the 8-day EMA, first crossed over the yellow line, which is the 21-day EMA, and then finally crossed the 34 line. So many traders use these moving average crossovers for making their trading decisions. So when 8-day crosses over 21-day, if you are an aggressive trader, you could actually start taking trades in that direction when the direction changes. However, confirmation only comes when the 8-day actually crosses over 34-day, which is the pink line. So that's the point where confirmation will come, and obviously when that happens, nobody can catch market tops and bottoms. So you will notice that you will miss out. If you were bullish at that time, you would have missed out um, this leg up. But obviously, from that point on, it's all money, money, money. If you are bullish, as I've mentioned earlier, I have been bearish. I'm on the wrong side of the trend right now, and I'm trying to figure out when to go bullish. But thing is, markets have gone up so much that now I'm at a point that I have to wait. I can't do anything. I have to wait for markets to pull back or hopefully get a nice correction so that I can go bullish. So if you use these moving averages, if you want to take bearish trades, my recommendation is that you wait for this blue line to cross over the yellow and finally the green. That would be your confirmation that you can start ramping up your bearish trades. And so, although I have been bearish, but I've been taking like one contract trades, really small trades. So my recommendation is wait for that to happen and then you can start ramping up your bearish trades. Now, Another thing I have introduced in our group recently is something called RRG charts, and real basically it's just sector rotation depicted in a nice little graph. So that's the graph. There are four quadrants: improving, leading, weakening, and lagging. The stocks, the sectors in the lagging quadrant are that is where the money is coming out. So you wouldn't want to go bullish on that. And you can see that utilities is one, um, biotech is one, consumer discretionary XLY is one, real estate is another one. And then you in the leading quadrant, how I use it, I have started using it is the stocks in the leading quadrant. If let's say my outlook is bearish on the markets, so the stocks this in the sector which is in the leading quadrant, I would prefer not to take bearish trades on that. Similarly, the stocks in the lagging quadrant, I would not prefer to take any bullish trades on that. So I don't pay attention too much to improving and weakening, because sometimes what happens is a stock may drop, a sector may drop out of the leading quadrant into the weakening quadrant and then go back up into leading. So to get confirmation, I want to see a sector actually, like real estate, going from leading to weakening and finally being in the lagging quadrant. That is when I would start looking for bearish setups or avoid taking bullish trades on that sector. So that's how the sector rotation chart looks like right now. Now let's switch to Think or Swim and look at a few charts. So this is the chart of S&P SPY, S&P 500 ETF, and what I've done is I've drawn this Fibonacci retracement levels for you, and obviously we are not in a pullback. We are not seeing any signs of a pullback, but if markets start turning from here, I mean, I would say look out below, because there is so much room to fall once the once this AI bubble deflates. You can see the way I use Fibonacci retracement is when markets start dropping. So when start dropping, as a technical analyst, you need to start projecting at what level markets might bounce back up, so that when markets start dropping, you start taking bearish trades. But at some point, you need to start reducing your contract size or exposure to the to bearish trades, because markets will turn back at some point. So as a technical analyst, your job is to figure out where could that point be. And Fibonacci retracement is a tool that I use for that. So for example, let's say SPY, hypothetically speaking, starts going into a pullback here. So you draw from the bottom of the move to the top of the current move. You draw a line, and then the Fibonacci retracement tool will plot all these levels for you automatically. So, and the thing is, you will see that 23%, 38%, 50%, 60, all these percentage retracement levels are there. So markets can bounce back at any point. So market could just be a shallow pullback. They come to this level and bounce back. It could go to 38% and bounce back. So usually 50 and 60% are very strong regions of support. That's why I've highlighted them in white. So markets, I mean, right now I know it sounds inconceivable that markets could drop all the way 50% until this point, but anything can happen. Once the sentiment shifts, then markets continue to go in the direction in the new direction for a long time. So one thing I would like to point out is when you're using Fibonacci retracements, look for areas of confluence. That's the best way or most reliable way of using Fibonacci retracement. By confluence, I mean areas of support. So for example, let's say the market start dropping here. So this region where the markets went sideways for some time, that is an area of support, which actually coincides with 38.2%. So that could be a very strong area of support. If markets drop below that, if this support is breached, then the next level is actually around this high August highs of 2023, which is slightly above 61.8% retracement. So this could be another area of support. So I'm just drawing these levels so that, because I'm just preparing, I'm hoping for a upcoming pullback, and these are the levels that I think markets could fall down to and before they bounce back. But now let's quickly move over to how the stocks, the high flyer stocks, the AI bubble stocks are doing, because they are the market leaders. They are the ones who are leading the market. So if we were to get a pullback, we need to see, are there any signs of weakness in the tech stocks? So let's start with Apple here. As you know, Apple has been beaten up really bad this year. So this is the beginning of the year, somewhere over here, and after that Apple has only fallen down. So it's on a downtrend. So Apple is looking very weak. However, note that this is a very strong area of support. So Apple is at that area, and we are seeing a slight bounce. You can see the RSI is sharply coming up. So Apple could very well see a bounce here. But if you look at the trend from the beginning of the year, it's still down. So that's Apple. Amazon still going up, hardly any movement. Meta. So Meta is kind of stalling at this level, but the thing is that and you can look at the RSI too. RSI is actually dropping after being overbought in this area. However, it's also entering a TTM squeeze, or a squeeze phase is a phase where the Bollinger Band, which is the green and red lines, are trapped inside the Keltner channels. And when that happens, the trading range becomes very narrow until there comes a point when it breaks out of that, either to the downside or upside. So Meta is entering that phase, the sideways choppy phase with low volatility, a low volatility period where I don't expect much price movement from it. So I'm staying away from taking any trades from Meta. Google, to me, it appears that Google is hitting this resistance around 155. And again, this is just a gut feel based on my experience. I have a feeling Google will start pulling back from here. So it's not going to cross over this. It will start pulling back, and RSI is not showing any clear signs of a pullback yet, but you can see that DMI indicator shown here, like the red line is moving up and the green line is moving down. That usually indicates a trend change is about to happen. It hasn't happened yet. In fact, I have a bearish trade on Google right now. I have a I think 149, 148 put spread, which is slightly out of the money. Not much, but slightly out of the money. So I'm hoping Google will pull back at some point in the next week. Microsoft is actually showing clear signs of a pullback, and as you know, Microsoft is one of the leaders. It's leading the AI movement. The stock is, the company is massive. It's a $1 trillion company. Apple is no more the leader, at least at the moment. Microsoft and Nvidia are the two leading stocks. And when you see signs of weakness in in these leaders, that's when something can break. So you can see we are seeing a series of lower highs and lower lows in Microsoft. RSI is dropping. DMI is also indicating that this upward momentum might be coming to an end. And since we are on the topic of the leaders, let's switch to Nvidia. Nvidia, again, I've drawn these Fibonacci retracement levels. Nvidia is also showing signs of weakness. So we had this massive engulfing bearish candle back in on 7th March. But then Nvidia kind of picked back up, but it's again dropping. It started to drop again. So this bearish engulfing candle could signal the end of the upward movement in Nvidia, and it just remains to be seen where we go, because we do have that PCE, core PCE on Friday, and that is known to rock the markets. So anything can happen on Monday. I don't know, but if uh, markets have a negative reaction to PCE, you will see that Nvidia will start pulling back really fast. And Nvidia, I would imagine that, I mean, there is so much room to drop here. It's crazy. This upward movement is ridiculous, actually. I would imagine that Nvidia could go down to 38% retracement, which is 780. But we'll see when it happens. So that's Nvidia. Netflix. So Netflix is part of this sector, the XLC sector, which is communications. In fact, let me just quickly pull up XLC. If you look at XLC, it's on a bull run. There are no signs of pullback. So I'm surprised that Netflix is actually showing some pullback, but I wouldn't trust that. You can see RSI is dropping rapidly. But we do have earnings coming up in less than a month, so I'm not inclined to take any trades on Netflix. Tesla, another market darling of last year, but it's been dumping since January. So that's January 1st is white arrow, and just Tesla is on a downtrend. So the leaders, the Tesla's, Nvidia is showing some weakness, Microsoft is showing some weakness, Apple obviously on a downtrend. I'm just using these as indicators about the strength of this bull run, and it appears to me that it's weakening. The only problem is this guy right here, VIX. So as long as, again, let me switch to a longer time frame, 1 year daily chart. So VIX was at 23 before the October correction. There was a correction that happened last year in September. After that, it has been like crushed to all-time lows. If you really want to know when a correction will happen, let VIX go above 16 and trade around in this region, this 18 area. That would indicate that market participants are getting nervous. It doesn't take too long for VIX to spike up, but it will start giving you some indication that a correction is about to happen, and the first signs will appear when VIX actually starts going above 16, starts trading around in this area for like maybe a week, above 16, between 16 to 18, and if it stays there, then you will suddenly see a spike up. So my guess is that since this is an election year, and election years are like 100% bullish, markets always end up positive during election years. So my long-term outlook is bullish on the markets, but there is going to be a correction. There's going to be a massive correction around 16 to 20%, if not more, uh, before, like, in the next couple of months. So I don't know when it's going to happen. So I do expect a massive correction that will reset the markets, because there is a reset is much required at this point. But that reset will only happen once VIX starts trading above that. As long as VIX stays below 16, forget about a pullback or correction. These markets will continue to rally. So that is the level that you need to watch for. If you just want to watch one indicator, this is that indicator. Watch VIX. If you see VIX trading above 16 for a week or so, let's say even like 5 to 7 days, that is an indication that a sudden rug pull is about to happen. So just wait for that. If you just want to wait, use one indicator, use that indicator. So yeah, that's the update for this week. I don't expect, I'm not seeing any clear momentum either to the upside or downside, and it could be because the markets are waiting for that inflation data to come, core PCE, and we will get the reaction on Monday. And if we get a negative reaction to core PCE on Monday, then things will start getting interesting.